Okay. Hello, everybody. This is Susan Quintanar. I'm with the Export-Import Bank of the United States government, and I'm here based in Atlanta, Georgia. Well, what I'm going to talk about now is what is very important to any business, which is money. A business may have the right talents, may have the right personnel, may have the right leads and contracts, but if the business has no money, then the business is not going anywhere. That is why my topic today is to make you successful. Now, what is Exim Bank? First of all, we go to the next page, right? When you think of Exim Bank, as the U.S. government entity, you would associate it with reducing risk and unleashing opportunities. We shall talk about exactly what Exim Bank is about on the next page, who we are. We are an independent agency of the U.S. government that was established in 1934, and our headquarters is in Washington, D.C. We have offices all around the United States, but particularly me, I am based in Atlanta, Georgia. Our goal is to boost the economy of the United States, to make sure that we support ex, made in the USA products and services in order to create and sustain US jobs. So we go to the next page to show you that Exim Bank seems complicated, but in actuality, we're very simple. I'm going to talk about the basic functionality of Exim Bank, just the basic products, and there are only two: financing and credit insurance. When it comes to financing, it's two-pronged. Either we support the financing of US exporters here in the United States, or supporting the financing of foreign buyers located outside the United States. I use the word support because Exim Bank doesn't lend directly. We lend through our delegated lenders. We have taught our delegated lenders exactly what we're looking for, trained in our Washington, D.C. office, so they know exactly what we're looking for. What we do is we provide a guarantee to the lender so that if something goes wrong with the borrower, then Exim Bank comes in to salvage the lender. So that's product number one. The next basic product number two is on the left-hand side, which is credit insurance. Credit insurance has two basic purposes. First is to make you sleep better as an exporter, right? Because there's so many rules, regulations overseas, and an exporter may be scared to sell overseas, and just to assure the exporter that if the foreign buyer doesn't pay on credit terms, right, then Exim Bank will come in to salvage the exporter. We would pay the exporter and we would be the one to run after the foreign buyer. So that's risk protection. The second basic purpose for credit insurance is to extend credit terms to the foreign buyers. It's very competitive out there. So export credit insurance enables an exporter to offer competitive terms, meaning to say on an open account basis instead of getting cash in advance, using credit cards or letters of credit. So even though the exporter has not tried any countries in the world, right, we would want to make the exporter sleep better by knowing, again, that if they don't get paid by the foreign buyer on credit terms, Exim Bank will come in to salvage the exporter and will be the one to run after the foreign buyer. So we go to the next page. Okay, the first requirement is to determine if we support the country. So in our website, www.exim.gov, we have a listing of all the countries in the world, alphabetically listed and further segregated into the exporter's foreign buyer, which is either the government or a private entity, and further segregated into the length of doing business. If it's short term, that means it's 1 year. And if it's medium term, it's up to 5 years. And longer than that is long-term financing. If you see a yes, certainly that means we support the country and the tenor and the type of foreign buyer. Just to let you know before I forget that we have restrictions on military buyers. So for the next page, we go into further eligibility. The exporter must have at least 3 years of revenue producing financials, for which 1 year should be in exporting business and should have a DNB number, DUNS number. Now, if the exporter doesn't have a DUNS number, the exporter can just approach me to get a free DNB number. Now, since our goal is to boost made in the USA products and services, we have to make sure that the US content fits the parameters. For short-term financing, which is 1 year, we require at least 50% US contents shipped from the US to countries that we can do business with in accordance to our country limitation schedule. We know most often that products may not be 100% made in the United States. So we're okay with 50% US content, and I'll give you an example. Suppose a $1 t-shirt comes from Malaysia. And then when it comes into the United States, the exporter tie-dyes it, puts fringes, embroiders it, puts another $1 in enhancing the t-shirt, and then that's shipped from the US to countries that we can do business with. That is already meeting the US content. Adding engineering, design, labor, overhead is good enough to comply with US content. Now for medium term and foreign buyers financing, right? Medium term equates to 5 years. Long term is more than 5 years. The US content becomes 85% US content. And again, it must be shipped from the US to countries that we can do business with in accordance to our country limitation schedule. So we go to the next slide, which is the spectrum of our product. There are two kinds of exporters. First, the first type is somebody who manufactures and makes the goods. So for pre-export financing, the solution would be a working capital guarantee type of loan. That's the technical term, working capital guarantee, right? Wherein we would provide a guarantee to the lender. Now, pre-export financing for manufacturers, they need to buy raw materials from the suppliers in order to make the goods. So they need to borrow money, and for this work in process inventory, and they can just say to the bank, to the lender, I need X amount of money because I want to make the goods to fulfill the orders. Now, once the products are made, then the exporter has to ship the goods to the foreign buyer. Once that is done, accounts receivables is created. Accounts receivables means that the foreign buyer owes money to the exporter, and the exporter is has receivables, expected receivables. And the exporter can also approach the bank and say, can I borrow money against this export receivables? So that is the manufacturer's spectrum. But of course, there are other exporters that are not manufacturers. Those are middlemen and traders. Like, for example, I have a customer who buys and sells frozen chicken. And therefore, he doesn't have inventory because what he does is he has a private label with Tyson. If he has an order from the Dominican Republic, example, right? All he has to do is contact Tyson and say, ship the goods on my behalf under private label. And since he doesn't have inventory, typically the solution is just credit insurance, and he doesn't have to have a working capital guarantee facility, because the working capital guarantee facility, just a reminder, is for export-related inventory and also foreign accounts receivables. But since he doesn't have inventory, he's okay just to have credit insurance and then assign the credit insurance policy to the lender so the lender can borrow against these receivables. And also, I will explain under foreign buyers financing, I'll explain later, right, what it is. And it's a direct loan and loan guarantee that would be the solution. So let's go to the working capital, to the next page, which is the working capital guarantee. This is our guarantee to our delegated lender, which is a commercial lender, which makes a loan to the exporter to purchase or manufacture U.S. goods and services for export. So my relationship as EXIM Bank is to the delegated lender, not to the exporter, but to the delegated lender. And the relationship of the borrower is not to me, but to our delegated lender. In the next line, you will see loan proceeds may be used to collateralize a standby letter of credit to be used as performance bond. There are times wherein the foreign buyer would say, I want everybody to send me a bid bond in order for me to realize that you guys are capable enough financially to join. And afterwards, if you join the bidding, I would like a performance bond to ensure that you can perform. When the exporter hears that, bid bond and performance bond and guarantee bond, those are instruments not common here in the United States. And therefore, the alternative is a standby letter of credit for the purpose of a bid bond or a performance bond. When a commercial bank issues letters of credit, they need to be 100% collateralized. But if there's an EXIM Bank working capital guarantee loan, it's only a 25% collateralization, which is certainly big savings. So next we go to the next slide to continue on with the working capital guarantee. We provide a 90% guarantee to the lender. And the purpose of the guaranteed lender is to elevate their level of confidence to assist small and mid-sized companies in obtaining working capital to produce and purchase U.S. goods and services for export. Just a reminder that it's kind of a challenge for exporters to borrow money from any commercial bank. because commercial banks are cautious or scared to lend because, again, of different rules and regulations, that the only way they would lend to a borrower is when there's a U.S. government backing like EXIM Bank. Okay, going back to this type of credit facility, it may be transaction specific or a revolving line of credit. Transaction specific means there's only one foreign buyer or one project. And a revolving line of credit means there are many foreign buyers involved, so it can be used for different different foreign buyers. The delegated lender will will be the one to determine the minimum and maximum amounts. But for EXIM Bank, there's no minimum or maximum amount, but we're not the lender. So it's really up to the delegated lender to deal with the minimum or maximum amounts. For the loan, it supports loan advances, right? Only against export-related inventory, including work in process, and that will be up to 75% on inventory and up to 90% on foreign receivables. I use the word up to because it's really up to the bank to determine their advance rates, not to exceed 75% on inventory and up to 90% on foreign receivables. So we go to the next page, right, which is the second solution, export credit insurance. Again, this is to increase the level of comfort of the exporter against non-payment of the foreign buyer due to commercial and political risk. For commercial risk, you can have a strong foreign buyer, but if the country is kind of unstable or weak, or there's an epidemic like the situation right now, then political risk can only also be a reason why an exporter would not get paid. So ours includes political risk automatically when somebody applies for credit insurance. Credit insurance can also be used as a marketing tool to be competitive out there. It's generally up to 180 days. Some products may qualify for 360 days. And export credit insurance is actually a standalone product. So it's not a financing product, but it can be used further to obtain financing. And the solution is just for the exporter simply to assign the credit insurance policy to the lender to increase the lender's confidence that if the foreign buyer doesn't pay, then EXIM Bank would come in to salvage the lender, but if it, the exporter, but if it is assigned to the lender, then consequently, it's protecting the lender. So let's go back to more information on credit insurance. What is commercial risk? It's insolvency, or when the company becomes bankrupt, or protracted default. They promised to pay on May 31st, for example, and they didn't, so that's protracted default. And also political risk. Well, sometimes there's war, revolution, or any political reason wherein the payment is halted or cut off, then that is also the reason why we can cover the claim. Just a little note, commercial disputes are not covered. So therefore, the contract must be very specific, very black and white, because commercial disputes are not covered. So we go to the next slide to continue on with short-term credit insurance. Uh, it's just good for 1 year because short-term equates to 1 year. And the coverage, when it comes to a claim, could be 95%, 98, or 100% coverage. It depends on the policy selected, the products exported, and the buyer classification. And it includes both automatically commercial and political risk. Now, there are two kinds of credit insurance. One is the multi-buyer umbrella coverage, wherein different foreign buyers can fall underneath the umbrella coverage. Or if the exporter only has one foreign buyer, it's okay to have single buyer credit insurance policy. And as he accumulates several foreign buyers in the future, instead of having several single buyer policies, he can just get an umbrella coverage so that all the foreign buyers would fall underneath the umbrella coverage. So we go to the next slide, which is medium-term financing. Now, this is foreign buyers financing, and medium term is up to 5 years. The U.S. content would be 85%. As you can see, it says 85% finance, 15% cash down payment. So 85 plus 15 is 100%. Once the credit facility is approved between the foreign buyer and our specialized lender, 15% cash down payment is required to be given to the exporter so that he can start fulfilling the order. So the difference, 85%, would be completely be financed by the specialized lender. For medium term, it's typically up to 5 years, exceptionally 7 years. And in the historical borrowings, it's 10 million or less. But of course, when it comes to EXIM Bank, the sky's the limit. It's not just 10 million, right? And we can go also for long-term financing for bigger projects, and long-term financing equates to more than 5 years. We will go to the next slide and just a summary of how our products can support an exporter. First, to obtain pre-export working capital loans to U.S. exporters here in the United States, we actually have the solution as the Working Capital Guarantee Program. And the next is to enable U.S. exporters to offer competitive terms to foreign buyers and reduce risk. And that solution is credit insurance. And the third one is to arrange foreign buyers financing with specific term loans at U.S. interest rates. Foreign buyers financing would typically just work for developing countries because the in-country borrowing rates would be so exorbitant. Like, for example, Nigeria right now, it's like, what, 28% if they borrow in-country. So the exporter's recommendation to the foreign buyer is, why don't you just borrow from the United States? And depending on the creditworthiness of the foreign buyer, and under the support of EXIM Bank, it will only be around 5%. So that's definitely big savings. So that's basically how EXIM Bank works. And those are my contact details. So if you have any questions, please feel free to get in touch with me. Thank you very much. Take care. Bye.